There's nothing more Australian than a tax-effective property development and making a shitload of money. Some tips for doing this, guys. So number one, you want the property to be in the right structure from day one. So whether it's developing your main residence or developing a block of land or multiple blocks that you're going to put together, you need to think about, is this in the right structure? Am I going to hold this individually? Should I have it in a trust? It may lead to some poor short-term implications such as no main residence exemption, things like that. But if you're planning that property development, thinking as far ahead as possible is really important. Number two, we most often recommend a development company, and that development company is going to take on a lot of that risk. This is more of an asset protection point than a tax point, but it's important for both because the asset protection is a huge part. You've got a very substantial asset that's got development approval and you can build on it and make money. If you've got that kind of asset and something happens, people will look to sue you because they know you've got assets because you're doing a development. A development company can help to reduce those risks to some extent, but also you need to put in the right structures to make sure, number one, you're not accidentally triggering a partnership for tax purposes. Number two, that the development entity is properly remunerated, which can be a good thing because if you own the property yourself, you may want to direct it to a company in terms of development fees, which should be taxed at the corporate tax rate, not the top marginal rates most likely. A development entity is a good structure, especially if you want to do this on repeat. It can help you have an entity that's full of cash that you can use for future projects. Number three is GST. So the sale of new residential premises is now subject to GST, including withholding and settlement. So you make sure that when you're costing out your profit, you factor in that you're going to have GST credits along the way, and you're going to have to pay GST at the end on that final sale event. You can actually use this to your advantage somewhat to get tax refunds as you go. And then at the end, you pay all that tax, which is the right time to do it because that's the time you've got cash coming in the door. GST is a bit of a complicated hot pot for property development. You've got a few things that can help smooth it out as well, like subdivision 153B arrangements. It's basically an agency arrangement where that development company can do things on behalf of the landowner for GST purposes, which does help in a number of respects at the end of the deal when you're actually trying to sell these things. But property development is complex. You need a good property lawyer, and most of the time you need a tax lawyer at the beginning to help you tell you how it should be done in the most tax effective way.